Thank you for watching Junior Mining Talks. My name is Antonio, and today Luke Denhaven and I are talking about losing money again. But more specifically, we're talking about how to lose money or how maybe not to lose money chasing discoveries in light of what has happened with newfound gold stock price, which went from about $13 in 2021 to now about $1.40 after they published their resource some 2 weeks ago. But before we start getting into the actual conversation here, though, I would like to warn everyone listening and watching that we have not received monetary compensation for the production of this video from anybody. However, you still need to understand that this channel is a business that sells content producing services to companies, which means you cannot rely on this video for research. Research is conducted by reading official company filings, which you can find on setterplus.ca. Please only watch this if you know what you're doing. This interview is intended only for experienced junior mining speculators because mineral exploration, development, and mining is a very tough business where failure is the norm and should be the expectation. This is going to be a conversation that is general and impersonal in nature, containing forward-looking statements. I am not a licensed financial advisor, neither is Luke. So before continuing on, please do talk to an investment advisor with a good long-term track record because your capital is at risk. And we are neither licensed financial advisors, nor do I personally have a good long-term track record. If you're not 100% sure you understand 100% of the disclaimers that I just showed on your screen, please go to the last section of this video and do not consume this content unless you fully understand and agreed with everything said herein. That all said, to be clear, this is not a newfound gold focused episode. There are many such stories out there. This is just kind of a topical thing. And I think a lot of opinions on the story have already been shared since then, and neither of us are geologists, and neither of us are, as far as I know, short nor long the story. So my goal here really is, and Luke, now I'm talking to you, but I basically want to understand the mentality of the hype or mentality of hype cycles, if that's a thing, like how not to buy at the top and learn essentially how not to be exiting liquidity. So we have a lot to cover. So just wrote down a couple of things, but geology, marketing, share structure, financing, there's a lot of things to talk about here, but let's maybe kick it off with the why, as in why do we, and as I'm saying this, I realize that I'm insulting you by putting you in the same basket as me, but why do people like me tend to chase stocks like newfound gold? And did you used to chase stocks earlier like that in your career, or like I mean, I don't even know if that's a question, but is that something that happened to you, and why does it happen?
Sometimes even the opposite. I'm trying to be so much of a contrarian that I was always looking for the worst of the worst that always remains the worst of the worst. I think that was more of a problem early in my career, and may still be a little bit of a problem. Trying to be cheap. No, I'm okay with buying a story and paying more for a higher share price for better results. So for a de-risked story in a way, and a de-risked story could already be one drill hole because that's one step closer to to knowing what you have than soil samples or channel samples or trenching or so no, I'm not really someone who jumps on hypes. Almost the opposite. um
But never
and I,
before, like when earlier on when you started, you, because that's happened to me a lot. Like I would get excited by very good drill results, especially a good pitch. I kind of like to like people, maybe because nobody ever likes me, but that's a different story. And so I would jump into a story just because of, I don't know, I like the drill results or I like the people, and I would
mm,
chase it almost irrespective of the price. So that didn't happen to you earlier on either.
not really. I think my problem is really the opposite. But I do see that people want to see a price response because a price response and volume typically tells you, finally money is coming in, external money, and something has changed. And it could still give you a little bit of a signal like, yes, this may be the breakthrough. On the other hand, do you need someone else, some other party or multiple other parties to tell you now it's real? Ideally, you can determine yourself. So if you really need the volume or need the price spike to confirm something to you, then you're not certain enough about your own uh, analysis, basically.
Yeah. Well, maybe it's mentality like FOMO or something like that, which I think I'm working against right now. That's something we've talked about a lot in previous conversations as well. Um, well, okay, so the question really is, if you do it, how do you stop doing it? Like, how can I see something like that in advance? Is there Is there something where you say like if it's a $2 billion market cap or a billion market cap and it's got no resource, I'm not I'm not looking at it.
Well, in just based on facts, companies that are not close to production, let's just say Great Bear Resources, one of the biggest successes ever. I mean, not close to production, major gold discovery. Well, of course, they were taken over, but it's, if we didn't know that a month before they were taken over. So you are looking at a $1 billion company, and you're thinking, if you're looking at it and considering it, like, should I buy this company because they have one of the best discoveries? I think you can almost say as a fact that most of the upside is gone. Because if you just look statistically, I think there's probably only 10 or 20 companies going back 30 years that was sold for more than, let's just say, $2 billion. And the names you think of as Philo, for example, or De Grey. So it happens, but it's very unlikely unless you have the best of the best. And the Great Bear probably fits that best of the best type discovery. But it's very unique. So I try to stay away from companies at that level. If if I've seen it, well, it doesn't really matter. It's also a psychological thing. But if you've seen it at 30 cents, 50 cents, $5, $10, $15, $20, and you didn't pull the trigger, why pull the trigger at 25? If you are following the markets close enough, then I would really want to see something so special at that point that would make me buy it at $1 billion. So I wouldn't do it. Other type of parties would do it, I guess, but not my strategy.
Hmm. Well, what if I did buy at the top, but want to cut my losses before it's an 80 or a 90% drop? I mean, in NFG's case specifically, it started gradually falling about 2 years ago. And it actually had stayed in a range of, call it, $5 to $6 for about a year before that. So it fell from a 12 to 6, which is a big drop, but it's still 50% better than a 90% drop, which sounds sad now that I'm saying it out loud, but it is true. So is there a way for me to tell then and there? Like, are there telltales? Like, what am I looking at to be like, okay, I made the wrong decision, kind of FOMOed into it, but now I'm going to sell instead of actually waiting for the resource?
Well, I think you have to ask yourself, how well do I understand this story, and how am I confident that this, whatever, 100 million or 500 million or 1 billion valuation, makes sense and has upside. I think we got a bit of criticism on our founders medals discussion probably half a year ago, because we all sort of suggested that we wouldn't buy it. We were not saying like it's not a good story, but I wouldn't buy it. And since then the stock went from probably $4, maybe even 380 to 5.5 or something. It's not. I mean, it was not about just founders. I mean, if I look at Newfound Gold, I mean, they had drill holes at the top of 25 meters of 150 grams, and that's huge. I mean, you almost never see companies release these type of results. But it was still obvious that they had these sort of, it was very, very driven by 1 or 2 or 3 meters of width. And I would never keep a story for so long completely, because there's always something that can go wrong. And of course, we can think back of, right now, Snowline still and Great Bear and Reunion. These stories are so good, they almost never really, I mean, they go down every now and then 20 or 15%, but not 50. The story just keeps on giving. But in most cases, that's not true. And I think if you are sitting on a winner, then you have to just, take profits every now and then, but not sell everything on one day, I guess. Because there's always something that can go wrong. And I think most companies will have that moment. Even Patriot Battery Metals, which is an amazing discovery, went down maybe 70% or something. And maybe the number is 60 or 50 or 80, but they went down significantly from the top because of lithium prices. So there's always a reason why a company cannot maintain its billion-dollar valuation. And I would personally just de-risk my position if you have such a big winner, or if you made a mistake and you can really not explain yourself why it's a good idea to keep the stock, then you should also sell it. So, and maybe you shouldn't have bought it to begin with. I don't have certain skills like if I have to work with 500 drill holes, how can I outsmart someone who works with the right software and has way more knowledge than me, giving some value to those 500 holes? So in the early stages, I may have an edge, but the more data becomes available, my edge probably fades a little bit.
You're bringing up an important concept, which I've also been thinking about. How can you tell the difference between a great drill hole and a deposit that's actually going to turn into a mine? And like, if the grades are that good or that high, how can the share price fall 50%? Essentially, that's what I'm also thinking about. But this is where you also have to start bringing in some geological knowledge. I think. I mean, continuity uh, is very important, specifically in this story, as far as I understand. Again, not a geologist myself, but what else? I mean, how can you look at something like that, and good drill results keep coming out. There's a whole lot of marketing and promotion. That's something we can talk about as well, and then still be able to sell.
Well, I think it's also, in my opinion, most people, probably 80 or 90% or more of the people cannot really evaluate, cannot really deal with so much data. I mean, there are people in the company working with these data sets every day, and they are working to get a good picture of what they are trying to delineate. How can an average investor, maybe not even having all the data, or collecting all the data and modeling it, and really do have a better view of this deposit or soon to be deposit than more sophisticated investors. So I think it's really thinking about how do I make sure that I'm not going to lose money here, and how do I sell at the right time? And the right time is not the peak. I mean, you cannot time the peak exactly. If you don't see after even a couple of months and you're still in the story, you don't see some good investors joining, maybe a strategic, um, maybe a major, or you want to see some confirmation. Like recently, Predictive Discovery, who made a discovery in 2020 in Guinea, I think. The Lundins invested there, and they invested a meaningful amount. I think it was $80 million or something. That sort of de-risks that story because it's a high market cap story, maybe $600-700 million. And if then the Lundins are still willing to put so much money into it, they didn't just do that based on an idea. They have done some work, and now they have de-risked that company a little bit by doing the work for themselves, but also for you in a way, because they are not typically traders. So that would de-risk it. If no one like that should show up, and you're just completely buying it because you think it's amazing, then then better have some good knowledge of what they have been drilling over the last couple of years. So I think it's really a matter of de-risking early enough, and you will probably sell too soon. But you cannot always sell at the top. That's just buying the bottom is way easier than selling the top.
We've actually done a whole episode on this, I believe. But following billionaires, what I wrote down is following billionaires, is it a good idea?
Hmm.
I think the conclusion there was that blindly following people was never a good idea. And there was a billionaire in this story, and I think there still is, still supporting newfound gold. And again, this is just the example of the company. But again, I'm just thinking, and I didn't participate in the story, neither to the upside and happily not to the downside either. But would I have been able to sell? It's like, again, good grades are coming up. Maybe you're not thinking about continuity if you're not a geologist and metallurgy, stuff like that, or pit wall optimization or whatever. You're seeing good grades. You're hoping gold's going to go up, and there's billionaires going into the story. So how do you recognize what's drilling for headlines versus what's actually work that's happening? I mean, is that something you can recognize?
Well, I think I still believe that Newfound Gold isn't. They were not drilling for headlines. I think they are doing a good job in terms of they made a discovery and they're advancing the discovery. What else can you do? I mean, you make a discovery, you get excited, people want to invest, you take money, you use the money, and you drill holes, and you have success with that. Uh, of course, at some point, they must have realized that it's a complicated system. Skinny veins sometimes. Sometimes it's not. It's way easier, of course, to drill 100, 200 meters width of zone and keep on drilling it stepping out 50 or 100 meters at a time and keep on hitting it. And at some point, find a limit. I think this is a bit more difficult with different pits, as we can now see in the resource estimate. But if you are in this story at 100 million or 200 million where it started, and you see Eric's plot invest more and better results come out, well, at $500-600 million, I would have started thinking about selling some, because how can you really put a real valuation on that at that point? Do you only want to maximize your profits, or are you also happy with a 5, 6, 7, 8 bagger? So I think no one should, unless you are an insider and you cannot really sell, should really take the risk and just hope for this thing to completely work out. Because nothing against newfound gold, most stories are not going to be sold at the top. Most stories will reach a top and go down. Like Wallbridge was another company where Eric Sprott was invested, and the company went from let me have a look, 130 to 6 cents again. And I mean, Hercules Metals last year, and Chalice Mining, and Amex Exploration, and Amark Resources is just a new discovery, and who knows what will happen. But most companies cannot sustain these. I mean, at some point they will find a top, and maybe it takes a couple of months before they can start drilling again. Maybe they find the limit earlier than you expected. I think it's really a matter of de-risking early enough, and how early. That's, I think, the most difficult thing. Finding these things is easy, I think, because most people who do this for a couple of years can recognize a good headline. And if you are willing to take the risk, you can buy some stock in the market. But then to do the right thing after that, of course, that's the most difficult thing. And that's what we are talking about today.
Are you telling me that I should just buy low and sell high?
Well, you cannot really buy low. In most cases, that's often the frustrating thing. A company, even, I mean, companies that I appreciate a lot, and I'm not saying that people inside the company were leaking, but you almost always see a stock go up in front of a discovery. And that could just be people speculating on, hey, they're finally drilling. This is an exciting project. Let me buy some stock because I want to be positioned when the news comes out. It could also be some visuals. I mean, there's people, well, let's not talk about leaks, but I mean, in most cases, you see a company trade up a little bit towards the discovery. And let's just say that the low of the year was 10 cents. The stock is 25 cents when they announce a good drill hole, which is not a very unusual thing, a bit of a run up, and not trading at a low anymore. And then at 25 cents, on the day of the good news, it opens at 35 cents. So you're looking at it in the morning and you think, well, I see the bid's already at 35 cents. The story was 10 cents just two months ago. But yes, they have this good drill hole. Do I really want to pay 3.5 times the price? That's the first difficulty. And I find that fairly easy, depending on the market cap. If the market cap is already approaching 100 million, then you have to be fairly sure that this is a groundbreaking discovery. Otherwise, 100 million is already quite a price. If it's still 20 or 30 million, but it's a big intercept, and you think this intercept cannot be killed within a week, for example, by the next hole completely killing the story, then I think it's for a short period of time a low risk bet, because everybody wants to be involved with it. So I think you want to understand who just made this discovery. Is it one small vein, or is it a big intercept like a wide one? And is it people that have done it before, or is it people with money and a network? And if it's a completely unknown company and you can really not find out anything, then of course be careful. But if it's a company like Reunion, with people that have been in the business for 20 or 30 years, they wouldn't just announce a headline just for the headline in most cases. So I think that's the initial part of thinking about, do I want to jump in even at 3 or 4 times the price compared to 2 months ago? And I find it fairly easy, because I think if I really think it's a breakthrough hole, then at least for a very short period of time, at least days, but sometimes weeks, there's not too much risk, because everybody's still excited about the new news, and the volume will only drop down a little bit later, and then the next hole is going to be the next important thing.
I think part of what a lot of people were saying when this came out was that it was over promoted too, and that kind of caused that overvaluation. So maybe talking about the topic of marketing is also important here. Is marketing always bad? Not necessarily. Marketing is needed for a lot of these stories to move forward, but there's overhyping on the one end, and then there's decent marketing on the other end. That's something that I know you look at. What are you looking for to kind of be able to tell the difference, maybe from that perspective, as in, is this being overhyped, or is this just decent marketing?
I think a headline tells you a lot, and I think a news headline should show that they think they have a discovery if they think it is one. But if it's only a very if it's a screaming headline, but the results are not in the news release, like the sections, the maps, and the intervals, then the headline is big, but the content, is weak. And that's, of course, normally a red flag. You have exceptions, but in most cases, you want the company to really tell you all about it in the news release, not just the headline. But I want to see a good headline. If company is just saying strong results or whatever, I think if you really have a drill intercept that really makes a big difference to the company, I think the intercept should be mentioned in the headline. But that's already a first step of marketing. That is in a way aggressive because you want people to see it. But that's important, I guess. You need to have you need to raise money again, so you need to ask for attention. I think it's all fine as long as you tell the facts, you tell it in a positive way. Every company will do that, and nobody ever warned me like this is a very well. They could maybe say it's a risky company, but much further they wouldn't go in warning you that it's a risky investment. So I think I have no problem with promotion as long as it's not really big campaigns of getting the big YouTube campaigns with 100 videos in 1 month's time to really get unknown people that have no idea into the story. That's not what I want to see. What I want to see is, companies trying to reach out to good investors and tell a story. I mean, in an interview with you, ideally, but no, I mean they should reach out to the market for sure. So I have no problem with promotion, and I don't know exactly what people accuse Newfound Gold of, and I haven't followed it in that detail that I'm bothered with it. But perhaps I don't know. I cannot really comment about their tactics or whatever they have done that's made people angry.
Yeah, same. I didn't, and maybe that's something that we could have done actually. Just follow it up and see, make kind of a case study on it to see what the promotion there was. But I've that's something I think about a lot, and I've written down a couple of things here. But I think the point that you made, I mean, if the CEO or the IR person is on every podcast and newsletter all the time, that's already raising my eyebrow. I actually prefer in interviews, I want to have the technical team, or if it's a technical CEO, I want to have them speaking more than the IR team. I think that's a tell in and of itself. Just showing drawers of the way the news release is written tells me a lot about how the company markets actually as well. Just like you put it, I mean, I need full context. True width is not always there, but at least they should say something about their estimation of what it is, true width versus apparent width. And stuff like that. I mean, how is it written? How much detail is it in there? Regular updates, like what are you doing? But not just updates for the update's sake. Like if there's just companies companies who issue news releases on small things that shouldn't have been news releases in the first place, and that's kind of more of a qualitative measure than a quantitative. It's also a red flag for me. Yeah, I think that's part of the things that I want to see.
Well, I think a lot of companies do have a bit of a sort of a news plan. I mean, of course, when somebody makes a surprise discovery, then the company may not have expected it themselves. But I do think that a lot of companies have sort of a plan for a year, like, hey, we will do these activities and we will spread out our news releases over this period, and they try to cover, So I think a lot of companies, and again, I'm not even so frustrated about it. I do realize that news flow is a thing. It feels a little bit like making a narrative, making a story, and the story should be real. So I don't really mind it too much. I just feel like a good team, and a good team often means that there's people involved, that people that are well known, that have a connection to other companies, and those companies are seen as legitimate companies, which makes the investment process much easier. And that combined with good news, like Newfound Gold, I mean, it was amazing news. I think it's an amazing discovery. But as with a lot of these high-grade stories, they can also be complicated and narrow and hit and miss. And of course, if you look at this chart and you see these drill holes, 40 meters of 20 grams, and 14 meters of 60 grams, and 17 meters of 125, and I mean, these right now, this overview doesn't show the including intercepts. Like, is it driven by one high grade meter, or is it really 70 meters of high grade? Well, I think that the research estimate tells you a little bit that it's a complicated system, and they did a lot of drilling to get to this number. I think that Eric Sprott recently was at the Crash Labs interview was a good thing. If you promote a story for many years and you tell everybody about the story, also be there on a bad day, and that's what he did. And they explained what they were going to do. I think they changed the management team. They have now some more. I shouldn't say more legitimate people, but people that have dealt with high grade systems like this before in Carora and in the other name escapes me right now, but they have done systems like this before, and now they are branding this more as a production story, and they actually may succeed with it. I wouldn't invest in I mean, Eric's product involved is a good thing, but I wouldn't buy a stock because Eric is involved. I think it's a very positive thing because in most cases he owns stock and he's not trading it or selling it in almost any name. So that's better than 20 or 30 retail investors, I guess, instead of Eric. But it wouldn't be the only reason. And that's a little bit different with the Lundin family or with Pierre Lassonde. If they are involved, for that reason, I'm taking a very serious look at it. With Eric, it would be a good sign, but he's invested in so many names that it would not be the reason for me to look at it. So, like in Lavras, he was involved, was a positive. He's actually selling that story a little bit, but I see that as a positive, him being involved, but not as a reason to look at it.
That's actually bring up a good point. That's something that I include in the warning of, I think, every episode, but it's knowing your counterparty's interest in finance, one of the most important things, in my opinion. So knowing why is the person who's telling me about the story, why are they telling me about it? And then also, why aren't they telling me about it now? So I said, if there's the CEO of the IR person is on a podcast weekly, you can reach out to the company and ask them, hey, why so much marketing and why now? Like, what's really the incentive here? And I think that's part of it too, understanding that these people own a lot of stock and they have an incentive to tell you about it, of course, is almost self-explanatory, but it's still a thing. And then also have realistic expectations for juniors that are that early on. Again, I think that's something you almost touched upon there, but if there's a market cap that warrants a 10 million ounce deposit, ask yourself, is that a realistic expectation? Like, how often has that happened? How often have we had 10 million ounce deposits? And then in the context of everything else, the right metallurgy, the right continuity that we talked about in all the other things. I think that's to the point of marketing, because that's oftentimes used as marketing. To the point of marketing, that's something that I think about it as well.
Yeah, but I think even Snowline, for example, which I think is seen by everyone as one of the best discoveries of recent years, and they do interviews as well. They go to conferences as well, small ones and big ones. They tell the story. I mean, they do good news releases with proper. I mean, there's nothing bad I can think of, and still, I wouldn't buy it at $1.2 billion, and it may be sold for $2.5 or $3 billion if they show that it is one of the biggest discoveries out there. And B2Gold is investing in it. They have other big names, in the name and in the company. So it will likely end well, but I would still think, maybe it's one of the few stories like Great Bear, which you could still buy and still expect to make some money and maybe some good money. But it is well, it's unfair to say it's probably a better investment than 90% of the companies below 100 million. So let's not just say like I'm going to look below 100 million just because it's cheaper. Snowline has a higher likelihood of still making you money at this market cap. But I am also hesitant to buy stocks at $1 billion or $2 billion. I would only consider it, and almost never I would do that if it's really big and really good. And I think that's what Snowline is, and that is what Philo is, and De Grey is. But still, I'm hesitant, and that I think is for. I mean, a lot of retail people will probably say that, and some institutions would have. I mean, they invest for other people, and they do a lot of work, but then they would invest in bigger stories. So I think that's fine that a retail audience looks at the smaller companies and the institutions look at some bigger companies. But if you look at this list, the one with the biggest market cap companies right now, without revenue, then the yellow greenish ones are the ones that are either taken out or they entered production. So they made it, you could say. Adriatic Metals is not taken over, but they made it to production, and they had some struggles, but they made it, I guess. The other companies didn't make it yet, but have high market caps, and high market caps in this case is everything between 300 million and 5 billion. And none of these names, I mean, all of these names, you could say is proper discovery, good discovery, but all of them still have risk, I guess. And they all have their own risks. Like WA1, they have a mineral that I don't know anything of, and you need to understand the market. You need to understand like what are the risks applicable to that mineral, and it had a really big run, and of course it came down a little bit. Well, not of course. Chalice is another name in Australia that really, reached a I don't know, even maybe $2 billion valuation or 1.5 billion. And then when the PEA, the scoping study came out, everybody was surprised and the stock crashed. And I think Chalice was seen as sort of a big, low grade but very big deposit, not like Newfound Gold, and also had a reason to fail so far. So I think every type of deposit, big or small, gold or copper, has certain risks, and I choose to not with my full position anyway, stay involved until the last day and take some money off the table if you are in a winner. And that's really the reason I had some criticism or maybe skepticism about founders. Not because I don't think it could be a good discovery, but it's difficult for me to evaluate these different discoveries they made and to say like, okay, this is worth 500 million or a billion or 1.5 billion. I mean, how can I really say that without having a good idea what the deposit is going to show for?
If you keep telling me to buy low and sell high, I'll stop inviting you because I feel like I know that. I'm just kidding, of course. Although I know it, I still have to actually learn it. Um, I think there's also a couple of simple metrics that you can use to make an educated guess that I wrote down, and maybe you can talk a little bit about that and whether you use something like that. But it's the kind of the known formula, back of the envelope math, if you call it, volume by grade by rock density. Volume by grade by rock density, with a couple of caveats. So you still have to know recoveries, you have to know strip ratio, you have to know continuity. So there's a couple of things that I kind of summarize in a discount factor. So I would do the volume, so length multiplied by width multiplied by depth multiplied by rock density, whatever, 2.8, 2.9, and then multiplied by grade as well. And then I would apply a discount factor to it and typically have a couple of scenarios. So I would have a good case, which is 80%. So I multiplied by 0.8. I would have a mid case multiplied by 0.5. And then I would have a scenario where worst case, like if I'm really wrong, I'd multiply by 0.2. Is that something you do? Is that something that works? Like, again, I haven't been using it long enough to know if it works, but is that something you do? And is that something you think it works?
Well, the short answer for me is no. I think it's well, if somebody makes a discovery, and like for example, recently A-Mark together with Freeport, and they have these really consistent intercepts, and let's just say they hit it over 250 meters by whatever width and depth. I would probably do a calculation very quickly to get a bit of a feel for, oh, this already goes in that direction, and then some smarter people will probably come out with a report and make a little bit more of a better educated guess. And I think people in A-Mark's case estimate, something between 2 and 3 million gold equivalent ounces. Well, I take that as information, and I think about it a little bit, like what does that mean and how much would it need to grow to be Freeport size? So I do think about the topic a little bit, but in most cases, I really look at who is involved, what is the type of drill intercept, how many holes did they drill, and did one of the holes already sort of found the limit of the system? And then you can do a little bit of this back of the envelope calculation to see what's roughly they would have already. I think it's really a combination of, is this a new discovery? Is it surprising the market? Is the company doing the right thing by doing a financing not too late? And that first financing tells you something, because if the right names come in, then they agree with you that this has potential. They're not saying this will work, but if suddenly Barrick or Kinross or B2 Gold or maybe even a Lundin family or whatever comes in, then at least that tells you that they also think that this has potential. And And to then really try to go too deep into, is this now 2.5 million or 3 million or 2.1 or 1.8? It doesn't really matter to me, because it's really, did they already found the limitations? How many holes did they drill? Was this historically drilled? If no, then it's completely open. Ramp for last year, they drilled, what was it again? 7 meters of 80 grams. Amazing. From completely out of the blue. But you just have to realize that this is still a very high risk prospect, that if they can drill it again 50 or 60 meters away, the stock will do well. And if they will not be able to find it, an extension in the next 10 holes, the stock will not do well. That's as simple as it is. And with these bigger intercepts like A-Mark, it's a little bit easier. So my initial no answer is not to say like you shouldn't do it, but I just feel like there's so many factors, and to put a number on it after 2 or 3 or 4 or 5 holes is not so important to me. I want to think about what's the potential here, what's the risk here, who are involved, and is this drilled before or not? And yeah, that's I think my answer.
You made a point there, and I was reminded of a question that I asked you before. Is like, how could I have sold at 6 instead of $1.40 if I was in this story? And I think one thing is, how much have they drilled? And in order for the deposit to be good enough or large enough to correspond to that meterage of drilling, how big will that deposit have to be? So Newfoundland specifically, they drilled, I believe, 700,000 meters. That's one of the largest drill programs I've ever heard about. And they come out with what a resource of 2 million ounces. That's also something that a lot of people are disappointed about. So maybe you could have looked at this, a year ago and think, I don't know how much they had drilled at that point, but maybe 600,000 or whatever, and think like, okay, so if they like, if this deposit is going to be large enough to correspond to all that drilling here, it's going to have to be 6 million ounces. So now I'm going to run the volume by grade, by density, by discount factor formula. And if that comes out short, even in the best case, then maybe now is time to take a profit. Does that sound reasonable?
Yeah, but in some cases, it's not just one deposit, right? Like in case of Founders and in case of Newfound Gold, it was not just one area. They are drilling in multiple areas. They're following structures, and sometimes you have a very good hit over here and they hit it again. But then the next one is a bit of a disappointment, and then a kilometer away, or maybe on a different structure, to the east, to the west, whatever, they find it again. So it becomes quite difficult to really start mapping these things, because you have these drill holes everywhere, and you cannot really put it together in your mind. And I'm not a geologist. I'm not I've never drilled a hole. So you're really working with, you're just looking at news releases and sections and maps, and you see that they are drilling in all kinds of different spots. And at some point, it's difficult to know what to make of it, because it's early stage, and you talk to the company, you ask them to explain it to you, and they often don't really know yet what they have. And I think all those factors combined just tells you that if you cannot really figure it out soon enough, then what's the problem with taking a bit of money off the table? Because so many of these stories are not going to work. And of course, we always think about the success stories like Philo and Great Bear and Skeena maybe and Adriatic, but a lot of these stories do disappoint at some point. So I think if you, just in theory, I bought Adriatic and I kept it until it was a 10-bagger, I think, from $3 to from 30 cents to $3, because I felt like it was a little bit like the Hot Maiden story in Turkey, where they pretty quickly found enough high-grade material that on its own it would work, and people saw Bosnia as the main risk. But in a lot of cases, what is the problem if let's just say you deal with $20,000, you invest it, and within a week or 1.5 or 2 weeks, that $20,000 is 45 or 50. What's the problem of taking that 20 off the table, 25? Of course, you would limit your upside a little bit, but if you can completely accept that the rest of the stock will just stay there, and you think, I will just keep this thing, and of course, you can reevaluate when it's a $200 million story or $500 million story if it happens, and then perhaps sell it. But I think if you take money off the table and you can accept not to make perfect decisions, because I think that's crucial. In most cases, you will not make perfect decisions. You will make mistakes, which are not really mistakes, because nobody knows when the top is in. And that's why you have to make educated guesses. And it's not just the deposit, it's also hype, and it's gold market. It is the names involved. There's so many different, it is insiders buying that can give you encouragement. But once those insiders stop buying and there's a drill, maybe the drill season is over and it takes 6 months, then everything becomes boring again. Stocks can go down 40% for no reason. So there's so many things you have to deal with and emotion, and that I think it's better to have a good strategy, and part of the strategy is selling some. In almost any case, I think. And I know someone who was in Great Bear almost from day one and never sold and made a killing. And even though that sounds very smart, in a way, it was an unacceptable risk, in my opinion, to do it like that. But he did very well doing it that way.
Well, new takeaway: buy low, sell high. But that said, I saw a meme this week on, well, maybe it's not a meme. I don't even know what's happening at this point. But there's a tweet from Trump. I suppose it's a meme, and he said, "No crying in the casino." So that's what his tweet says, and that kind of reminds me of the venture too, as in failure is the norm and should be the expectation here. And again, that's something that I put it in my warnings at the beginning. I know some people are annoyed, but the disclaimer is too long. It's not just some disclaimer; it's a warning with a lot of things that happen here, and that's part of it too. Which leads me to the question: should speculators even be in this space, or is this space really for everyone? And I think it's not for most people, really. So should retail even be in pre-resource companies? What do you think?
Well, yeah, retail is very important. I think retail is not just, I mean, a lot of people think of retail, the name retail, as dumb people trying something, but in most cases not succeeding what they're trying. Just not, just people with a job and not thinking about it, but taking risks. But retail is also smart people investing big dollars in, high risk stories. And I think Rick Rule has a quote like this as well, but I looked at this Warren Buffett quote this week that said, some people should not own stocks at all. And this is not even resource stocks, this is stocks in general. They just get too upset with price fluctuations. If you're gonna do dumb things because your stock goes down, you shouldn't own the stock at all. And dumb things is selling the stock just because it's going down. And he was saying, like, if you buy a house at $20,000, which is, I think, quite cheap for a house, but maybe he was thinking 1950s. If you buy a house at 20,000 and somebody comes along and says, I will pay you 15,000, you don't sell just because somebody makes you that offer. And I looked at some stories this week, stocks that I owned that were trading last week at 35 cents, are trading right now at 24 cents. Does it hurt? Maybe a little bit. But if you start looking on Twitter and you look at 50 or 100 opinions, and then you go back to another chat site, and then you look at the store's chart again, at some point you can make yourself crazy by looking at all these data points. And if you just sit in the garden and you think about it without all the data on your screen, and you just properly think about it, and you think, selling right now, does it make sense? What do I think this company is worth? Of course, it's difficult sometimes in junior research stocks what something's worth, but I think you should think about it not sitting behind the screen looking at a chart that's going down and with 20 opinions within your timeline. That's not the right way of thinking about the right decision. You should think about it in the garden or somewhere where you have time to think and not being distracted by all kinds of opinions, and think, can I deal with this pressure? Is there actually pressure? And do I still believe in this company, or are you smart enough to have liquidity and buy more? But I think the answer is no. Not everyone should do this, especially resource stocks. And it is sometimes painful. I'm not going to say that some of these stocks dropping this week didn't hurt me at all. But if you think about it and you take a little bit of a moment to just accept that this is the game we are playing, then indeed you pretty quickly come to the conclusion, like, this is indeed the game we play. And if it hurts too much, then you took too much risk. And I think everybody in a way does that. Almost everyone, taking too much risk with too much money.
So conclusion: no crying in the casino. I think that's a good takeaway.
Ideally, and that I've been thinking about it so much, and it's difficult. But ideally, you have a super fixed strategy, and you do not deviate from it. I still make decisions that I was planning this year not to do many financings, because financings often come not necessarily because you find something, but because a company finds you tells you a story and you decide to put some money in the story. That's in most cases how a financing works for me, because you get so many ideas and so many companies reaching out to you. Of course, companies that I already own and coming with the financing, I consider because I know the company and I just think, do I want to own more at this price and whatever. And I did 2 or 3 financing this year, which in the beginning of the year I said, no, I'm not going to do it, these type of financings, and I did it anyways. And that's already a bit of a mistake because I didn't follow my own strategy. I think having a very fixed strategy, like I know what I'm going to do this, with my money and with my time and with, and following that strategy is important, and you can change it. But just buying a story because somebody tells it to you, and within 2 days you decide, yeah, let's just do it, is in a way already a mistake, because you deviate without adapting your strategy, but just deviate because you like the story. And I think the better you are at following your own ground rules, the easier it becomes. And I still struggle with following my own ground rules.
Well, one of the rules of the casino is that the house always wins, right? And I think that's I don't think speculating in junior mining is gambling in its purest form, but there's elements of it to it as well. And oftentimes the house does win. It is insiders and brokers and so on and so forth who make the money more often than retail does. And I've been thinking about what can you do to try and help yourself. I think the first thing is that you need is experience. So build experience in losing money. And then I've or hopefully eventually making money. At least that's my hope for myself personally. But I think basic geology, understanding deposit types. This is stuff that you can learn for free. I've said it multiple times. There's even on YouTube. There's a course I think on ore deposits 101. It's called. It's from Sprott. It's an older playlist, but it's very, very good information in there. But stuff like that, basic geology, basic ore deposits, understanding what's possible and what's not going to happen. That's also going to lead you to understanding some exploration stuff. So drill results, understanding drill results, knowing what's grade, width, depth, what's good, and so on and so forth. Metallurgy goes hand in hand with that as well. And if that already sounds boring and complicated, then maybe no, this sector is not for you. I mean, if you're not going to do geology, if you're not going to do metallurgy and stuff like that, maybe the sector is not for you. I think you might disagree or not, but we'll see about that. And there's other stuff as well. There's just so many moving particles. There's macro matters, not as much as geology, in my opinion, but macro matters, political, social, permitting landscape of the jurisdiction, stuff like that is what I wrote down. That matters as well. Knowing and being able to read the financials, knowing how much money they spend on stuff. Those are stuff that I cover in my interviews right before the interview actually starts. I do a kind of a company overview, and I do 2 ratios. One of it is administration to exploration, how much money went into G&A versus how much money went to exploration, and then drilling to marketing, how much of the exploration spent was actually drilling versus how much was marketing. You want an exploration company, not a marketing company. So under almost no circumstances should they be spending more money on marketing than they should be on drilling and stuff like that. But you should be able to understand the financials to at least that part of the detail. Management background and kind of knowing people knowledge, knowing people. You kind of have to know when someone might, twist the truth. I mean, I suppose we often say lying in a space. Lying is obviously not allowed, and I think a lot of people lie just straight up, but a lot of them do twist the truth, and that's something I struggle with. Again, the people knowledge, and as I said, I like to like people. So rarely am I going to think like, oh, this guy's trying to rip me off. Rarely do I think that, although that is probably sometimes the case. And then the thing that you pointed out on with the Buffett quote and everything, emotions. So being able to manage the emotions. And then the last thing that I've written down, at least, and I'll hear your thoughts on it, is position size management. What's too big of a position? Because that's again to a point what you made is like if you have too big of a position, if it's 50% of your portfolio and it goes down 50%, then we've lost 25% of your portfolio. If I'm doing math off the top of my head correctly, and if I am, that's actually an achievement because I'm not fainting. But yeah, those are kind of the basic points that I have. Like if you want to not be the victim, essentially, you have to. And I'm laughing because it goes back to our previous conversation last week or the week before that. But you have to be able to at least do these things that I went through. Do you agree with that?
Yeah, but you said in the beginning, insiders well, you mentioned brokers and insiders. I think insiders, if they're really insiders, do only win in bad stories if they get a big salary. Because if they get options and the stock is not going up, they don't win on options. And if they, you know, well, if they get cheap stock, maybe then they win. But then they would have to not being an insider and then sell when they are no longer insiders. So I think that's why insiders is very important to me. Who runs the company and who owns shares and what did they pay for it, and are they maybe buying in the market as well, and meaningful amounts for them remains a very important one. Even though there will be companies that are good without insider buying, for sure. And the ore deposits comment you made, I agree, but I always found those geology classes boring until I actually cared. And why did I care? Because I wanted to know about porphyry or VMS. So I think, but that's for me. Some people can learn stuff without necessarily benefiting from it themselves directly. I felt at the time that I wasn't really consuming the information because I did want to know about it, but I didn't want to know enough. And only when I started to really be interested because of my positions, for example, being invested in a VMS story or being invested in an orogenic gold story, and at some point trying to understand what they are telling you, at that point it becomes fun to learn and to listen to, geology classes, even though you will never become a geologist, perhaps. But so I think it's indeed important, but for me, it only works if I have really a direct interest in the topic at hand. And for some reason, I only started investing in porphyries, well, after a number of years of doing this game. And that's why I didn't know much about porphyries until I really started listening to all these Sprots type videos indeed. So yes, I think it works, but you have to be open, you have to be interested enough to listen to these half an hour, 1 hour, very technical briefings, right? And metallurgy, I still like stories where a lot of unknowns are there because then I have an edge, and in most cases there's no metallurgy. I like companies that are so early stage that it's really big land position, so you cannot kill the project in most cases very quickly, but not stories where there's so much data that I have no edge compared to anyone else unless I know the people in the company. And I trust them enough with their story that I want to invest in them with their plan with an old deposit or something. For example, like the Osino guys right now in Namibia, they took over a copper deposit because they think they can make it work. And then I would invest because those people are running this company, not necessarily because I think I have the ability to understand this deposit better than a lot of other people.
I think basic metallurgy, you don't necessarily need the company to have done perfect met testing and give you the recovery rates, but understanding stuff like recovery gold, even thinking about it in the first place is already probably putting a lot of people ahead of most speculators, I think. But is it refractory and free gold versus log gold type of thing? I think you can know that early on,
yeah,
with some background work. I think that's what I mean when I say metallurgy. That's part of it.
Yeah, no, that's right. That's right. I think it's you can already get something out of the initial drill results. I mean, if there are byproducts, it could already give you a bit of a clue, or in general, being in a certain belt or close to another deposit. So for sure, that's one of the things. Let me have a quick look what you said. Lying, yeah, that's true. I think most people that you come across in the industry are nice people, friendly people,
Yeah.
telling you a story. And in many cases, or almost all cases, there's not something to be uh, immediately worried about. But for sure, there are people, selling dreams and maybe knowing that they are selling dreams, which again is also a part of this speculation game. But it should be a real dream and not just the dream. So there should be a real idea behind it. It remains a very fun business, and I think it's still a people game in many cases, and not just you trying to find the best project. I think it's part of it, but good people is reducing the risk more than you trying to understand the project better than anyone else. It is my experience.
There's a couple of telltale signs actually that you can kind of couple metallurgy with that part that you're now talking about is to the people. But if a company's been at it for a long time, drilling for a long time, and they haven't done any met work, I don't like that. Like I want them to be thinking about metallurgy either in the first year or year two of drilling, where they're like, should we even keep drilling in the first place? Because if the gold is not coming out, we're not recovering it. Why should we keep drilling in the first place? But another thing is when they start talking about alternative processing, that most of the times that's not an immediate red flag, but most of the times it is kind of a yellow flag. It's like, let's look into this. What do they mean? Alternative um, bio-oxidation or whatever it might be, roasting and stuff like that. They're oftentimes challenging. So that's one other thing. But yeah, I mean, that's a telltale sign when about metallurgy in and of itself. Like if you don't know or understand metallurgy, and I don't know or understand metallurgy, but I do ask about it because I want to see how the company answers it more than what they're going to say. And that's kind of a two birds with one stone, because it tells you a lot about the person, but also maybe tells you a little bit about the metallurgy.
Yeah, for sure. And I think if you decide, I mean, if you buy a company, and during this conversation, I'm all the time thinking about companies in the early stage process of making a discovery, or recently made a discovery in the last year or so. I'm not thinking right now too much about companies trying to reinvent, like sort of work on an old deposit, which is also a strategy that could work. But again, I would only do it if the people that are running that show, I know them very well. In case of a new discovery, sometimes you just see a news release, you see a discovery, and you have to decide pretty quickly whether you want to be involved in it, and then you don't have that much time, and you look at the names involved, and if those names give you some comfort and you buy it in the market, then your due diligence process really starts, right? And of course, first you talk to the company, and then if things are going well and there's new investors coming in, you can try to talk to them why they are investing. So I think the networking thing outside of the big networks, the big names, but your own networking game is important too. Calling companies in the area, ask them what they are doing. Are they looking for this deposit type? So get multiple opinions from all kinds of directions, and not necessarily that you have to believe everyone, but all these opinions give you a data point. At some point, you have a bit of a benefit. And I think two examples I gave recently, that A-Mark, when they made the discovery in January, that was during the conference, and we immediately in the same morning, we were probably the first people, or the second, I guess, to talk to A-Mark at the conference that morning. So you immediately get the company, and you can discuss it with them, and then you talk to industry people about it, and you can very quickly gather so much information that you cannot do if you're just sitting by yourself. And of course, you will not always be at a conference, but this worked out really well in early this year when A-Mark made the discovery.
That's probably a good note to end it on. I think next week we're going to be talking about whatever's happening right now in the markets, actually, because it seems like there's a lot of uncertainty out there. But what else for this week? Do you think that's it?
Well, yeah, this is well, I think this is the main topic, how to deal with. Again, we discussed these type of things a lot, but to when to it's really a question, I think, about when to sell. It all in the end, there's just two decisions that have to be right. That's the buying decision and the selling decision. Everything that supports those two decisions, right? And we talked about newfound gold, and I think the discussion is, should I have bought us and sold it? And of course, all the work that you do is essentially to make those two decisions. And I think the selling one is the most difficult one. Um, and and my conclusion really is, that's this my conclusion. People with other skill sets would probably have a different conclusion, is de-risk early enough. And I'm often too early in de-risking it. But at some point, there's always a risk of this thing not working. And that's sort of my conclusion for this week. That not just live by hopes and dreams, but be realistic and look at this. You didn't make a joke about my list this week, but look at my list, and there's just a few companies between 500 million and 1.5 billion, and that will always be a very short list at any point in time, maybe less than 1% of the listed companies. So don't just dream about that outcome. Also think about the outcome of that not happening, and that's something I do a lot.
I did make a joke about your list, but it was actually before we started recording, and I said that if you want to get very popular, you should just say that you wouldn't touch any of of the companies on this list. That's going to make you very popular out
That's
there.
right.
Uh, but no, it's been a good recap. Thank you so much for your time.
Thank you.
And thank you to everyone for listening and watching. This was an interesting conversation. Any and all questions for future interviews are, of course, welcome. Please post them in the comments. But I am still going to kind of repeat the warning that I said at the beginning, that everything, everything combined with the warning that I gave you at the beginning is to say that you should treat this program as biased entertainment instead of unbiased journalism, because there will always be some type of bias in what everyone tells you online. They may own shares of the company, they may be a director, they may have been paid by the company, and so on and so forth. Now, this entertainment program specifically is intended only for experienced junior mining speculators, because mineral exploration, development, and mining is a very tough business. Losing money is the norm and should be the expectation, as this is a very complex sector, and the performance of individual companies typically depends on many different things, including geopolitics, macroeconomics, commodity prices, and many other moving particles that are typically outside of anybody's control, and no one can really proceed him, because unfortunately, and believe me, I have tried and I might even keep trying, though I doubt I'll ever be successful. I just don't possess any superior knowledge about the potential direction of any stock or commodity price. And at least to my understanding, nobody out there does. So you should not rely on this program for directional advice or advice of any sorts, as this was a conversation that was general and impersonal in nature between a couple of individuals, none of whom are your licensed financial advisor and none of whom can see the future. So no guarantees can be made about future events, and past performance is not a guarantee of future results. So please talk to a professional licensed investment advisor with a good long-term track record, as well as do more research before taking any decisions by visiting setterplus.com, where you'll find the official filings of the companies that might have been discussed in here today. And if you don't do that, you're highly likely to lose your money. There's a couple of documents that are absolutely obligatory reading for people interested in the space. And that is, of course, the MD&A, which is the Management Discussion and Analysis. And it's an official document that the company publishes on setterplus.ca. You want to look at the financial statements of any company and understand how and why and where they spend money. And you also want to look at the Management Information Circular, which is going to tell you how much money each insider of a company earns in total compensation, bonuses, and everything, and all the other incentives that they might have. It's also going to show you if there are any change of control fees and whatnot. It's a very important document. And then, of course, this is a technically focused business. So you also want to read the NI 43-101 technical disclosure. And again, if you don't understand it, consult with someone who does understand these things. Because if you don't do that, you are highly likely to lose your money. So, yes, thank you so much for listening to this. And I'll leave you with one of my favorite Charlie Munger quotes, which was, if you don't understand it, don't do it.